Let's turn our attention back to the markets because we have seen specific stocks under pressure as a result of this fire sale that we have seen. Viacom, CBS, and Discovery, those under pressure, as well as financials as a whole. The sector is down about 1.7%. Let's bring in Barry Bannister. He is Stifel Chief Equity Strategist. Barry, you've been hearing Oscar sort of walk us through the backdrop of all of this. How do you assess the collateral damage?
Well, when you think about what the hedge funds have been going through, not only are their shorts being attacked online with Reddit and Wall Street Bets and other subgroups, but some of their long bets had really been too far out on price earnings ratio, on valuation. When real yields move ever so slightly, and we've gone from -1.1 on the 10-year tips, or the real inflation adjusted yield of the 10-year treasury, from -1.1 a few months ago to about -6 recently, 0.6. That small move has a huge effect on the price earnings ratio. It's due to a bond concept called convexity. You don't get a linear relationship on valuation when you get a very small change in real yields. The Fed really caused all this with their PE suppression, their real yield suppression and PE expansion strategies of the last year. And so we're seeing fallout from that.
How should we be looking at the sell-off stemming from this particular incident? You think it's pretty contained, or is this kind of the tip of the iceberg?
We have only the guidance of Credit Suisse and Nomura in terms of the impact to their first half earnings. So we have nothing to add to that other than the fact that prime brokers are always at risk if their clients blow up. I think the bigger issue in the market is we've pretty much solved what main things to watch to know the direction of the market. On the one hand, it's the real 10-year treasury, the 10-year tips. It's the first thing I look at every morning and overnight. That will have a huge effect on the market's preference for growth versus value. If you have a suppressed, deeply negative at low inflation real yield, you're going to have a very strong PE-driven growth stock-led market. On the other hand, if you start to see a higher real yield, reflation, the stimulus bills are absolutely enormous. We haven't spent this much money since World War II in 1 year, and we've done it in 1 year on this virus. If we don't get growth and reflation out of this and Fed policy, we are never going to. We're going to fall into a deflationary trap. So this is all or none. It's a bet by policymakers, all or none to reflate. If they succeed, then value stocks should do better on a higher real and nominal treasury yield. The other thing we watch is the dollar, and that really captures the non-harmonious growth around the world. Europe is lagging, Japan is lagging, the US is coming out pretty strongly. China already came out strongly.
We've seen a lot of investors look at financials as a potential opportunity in the high yield environment. What we're seeing today, of course, there are some questions about whether there's inherent problems with the risk management for financials, whether that's a fair discussion or not beyond Nomura and Credit Suisse. Where do you stand on financials right now? What's your positioning there?
There's a big difference between the way, just throughout all time, iBanks and former iBanks were run with leverage and risk, and the way traditional banks are run. And I'm talking everything from mid-cap banks, regionals, to large banks that tend to have pretty good risk controls, like JP Morgan. They don't tend to have these problems. If you look at the treasury yield, this is the 10-year yield, oddly enough, they're not really spread lenders, but oddly enough, they have high correlation to the 10-year treasury yield. 10-year treasury yield goes up, banks tend to do well. Goes down, curve flattens, they do poorly. That's just a reality, and we watch that. So if you believe in reflation, you believe in growth, you believe in financials as well. But if you don't, you think we're going to have a curve flattener and near zero on the 10-year treasury, and Fed's trapped having to do infinite QE, and we're falling into a deflationary trap, then don't buy financials. They're not going to work.
You talked about the rotation from growth into value. What are other particular sectors that you've got your eye on right now?
Value is fairly well diversified. If you look at it, there's a good weighting in value in just all 11 S&P sectors. So you've got energy, industrials, financials, basic materials, utilities, consumer staples. When you look at growth, it's just one thing and one thing only. Tech. Okay. It's all technology, software, semiconductors, and hardware, which includes Apple, by the way. They're a hardware company classified, even though it's a software company. They're within technology. And then when you look at communication services, that's got your Facebooks and your Googles and your internet names. And when you look at consumer discretionary, which is mostly retail and autos, you're going to have a huge weighting in Amazon and Tesla. So if it's tech, it's growth. If it's not tech, it's probably value.
Okay. Pretty easy distinction there. Barry Bannister, Stifel Chief Equity Strategist. It's good to talk to you today. Appreciate your time.